Hi everyone, Phil Rogers and Lauren Hall here from Loan Market Edge. So unfortunately, as we know, the cash rate has gone up and so has variable interest rates. So let's have a look at the difference between fixed and variable rates and help you figure out which could best suit you.
The first one is fixed rate loans. A fixed rate loan is one that maintains the same interest rate over a set period of time, regardless of the market fluctuations. Fixing your rate gives you confidence around budgeting. You can plan out what you can afford. However, you can only fix for a set period of time, say anywhere between 1 to 5 years. It can also protect you from the volatility of potential rate movements.
So a fixed rate loan usually comes with a few provisos though. You may be restricted to the maximum amount of repayments you can make during that fixed term and can face hefty break fees for paying off that loan early, selling the property or switching over to a variable interest rate during that fixed rate period. Also, you may not be able to leverage an offset account against a fixed rate loan.
You should also consider and be aware that at the end of the fixed term, the rate will usually revert back to a variable interest rate. Coming out of a fixed term can be a shock if rates have moved significantly in that time. You should keep an eye on how interest rates are moving so you can plan for any changes. Look at your household budget if you need to. Make some allowances for rate changes so the impact isn't so hard.
You should also talk to your mortgage broker, aka us, when the end of the fixed rate term is approaching, as many lenders don't offer the lowest interest rate when you roll off. So you want to make sure that when your loan reverts to a variable rate, you're getting the best possible rate.
The next one is variable rate loans. The interest rate on a variable rate loan can change throughout the term of the loan in reaction to market fluctuations in interest rates. The interest rate on a variable loan can go up or down. It's fair to say choosing a variable rate can carry a bit of risk. While interest rates are low, variable rate holders enjoy the benefits of interest rate cuts. However, should rates rise, their home loan is hit with a rate increase. At the moment, you're probably aware they are going up.
A variable rate loan may come with some features such as an offset account, which can reduce the amount of interest you pay, and a redraw facility. Also the ability to make those additional repayments either regularly or in a lump sum.
A variable rate loan can offer flexibility. However, you should consider the capacity to service the loan when interest rates increase.
So maybe a split loan. Let's talk about the best of both worlds. Another option is to take a combination of the fixed and variable. There are options to split your loan so that you'd say have 70% fixed and maybe 30% variable, or any ratio that obviously meets your needs. But this can mean you benefit from rate cuts, but if they do begin to increase, only 30% of your loan is affected.
The key questions to ask yourselves are, what are you wanting to achieve? Do you want consistency of repayments to help with budgeting? Or would you prefer to take advantage of lower variable rate interest rates today compared to fixed?
Be aware that if you do decide to go with fixed and you want to change to variable, there are usually penalties from the banks to break a fixed term loan. With some extra guidance from us, your brokers, you can make more educated decisions. So give us a call, let's talk through your options, work out what's best for you. We'd love to help. Bye for now.